First of all, I think if you look back at this correction, it has been so much like the historical script we've seen after sharp corrections. It's normally taken about 6 to 14 months for stocks to make new highs after deep corrections. We're 7 months in. And I will tell you, with all the news we've had, all the negative headlines over the last few weeks, look where stocks are. We're less than 2% from an all-time high. So I think stocks have been very resilient so far.
Brian, do you think U.S. stocks are attractive here, or would you be telling clients to put money elsewhere? I mean, we've seen huge pullback or correction in emerging markets. Does that look attractive now?
Well, I have to be perfectly honest that I've thought emerging markets were attractive even before the correction, so I've been wrong on that, clearly. But I do think that still they do represent some very good longer-term value on the basis of, say, price to sales, price to free cash flow, price to book, whatever metric you really want to look at. I think that emerging markets have and continue to look very attractive relative to their domestic peers. Now, obviously, there's a lot more risk entailed with emerging markets, as being evidenced over the last few weeks, if not the last few months. However, I agree with your other guests as far as the idea that even U.S. stocks, I think, can break to new highs as soon as we get through this trying period that's currently, it looks like it was most recently triggered by the travails in Turkey. I think that it is going to be proven that Turkey isn't going to represent some sort of contagion risk where it spreads through the financial system to other emerging markets. And as long as the fears of contagion don't become a reality, I think that sets up a very good foundation for a move higher broadly for risk assets. And we are currently overweight emerging market assets in a lot of our portfolios.
Keith, what should the smart investor take away from Walmart? It's one stock, but it's a big, important one. The consumer has been strong, but at the same time, margins at Walmart, particularly Walmart US, affected by, hey, they're lowering prices to juice the top line. So what's the overall message here that an investor should be paying attention to?
Well, I think the bigger picture, including Walmart, is that the consumer is actually in pretty good health. You look at retail sales yesterday, up 6% year over year. You look at the Atlanta GDP Now estimate for this quarter, above 4%. You have initial claims hovering at 50 or near 50-year lows. And then you also had other good earnings reports from the likes of not only Walmart, but then we had Cisco overnight. So I think the general message should be that the U.S. economy, despite the tariff news, despite the headwinds overseas, is just humming along right now.